Welcome to the Textbook Opportunity of the Day report, Friday the 3rd. And what a day it was too, with the figure coming out at 12:30 stateside. The market rallied after the figure to break above Thursday's highs, then collapsed to break below Thursday's lows, and then rallied yet again to finish pretty much unchanged. Let's focus through the eyes of the L.I.V.E setup, or setups, to see what the clues were for the rally before the figure came out. Courtesy of the 60-minute chart, you can clearly see that the bar highlighted has a lower low and a lower high and a lower close. The ka-ching moment there is the fact that the range is smaller than the previous bar's range, saying the sellers are not the dominant force. Formally, the 60-minute is a buy setup, specifically being a bond trap buy. This is at 12 o'clock, half an hour before the figure's coming out. Focusing on the 30-minute chart, the bar that finished at 12 o'clock, the highlighted bar, lower low, lower high, lower close, black real body. The range is not expanded, thereby being in confluence with the buying setup, courtesy of the 1-hour chart. The 15-minute view, the down closed black bar, 12 o'clock is formally a fake out buy, breaking below the previous spike lows. The long position is triggered on the very next bar, finishing at 12:15. The bar that finishes at 12:30 on the 15-minute chart is a promise of higher highs to come before the figure came out. The 30-minute chart at 12:30 before the figure came out was also a promise of higher highs to come. The promise of higher highs was fulfilled with a vengeance when the figure came out, rallying to break above the spike highs and above Thursday's highs. The market remained there literally for 1 minute, 2 minutes, giving one the opportunity for a quick 1 hour or 2 hour return on that long campaign that was signalled by the bond trap buy on the hourly, the confluence on the 30-minute, and the 15-minute fake out buy. This highlights the need to believe what you see rather than see what you believe, and then to act nimbly. What I find truly fascinating is that a rule set that was conceived in the early 1980s, born in the middle 1980s, had its baptism of fire in the crash of '87, to see it still performing in the year 2012. Focusing back on the hourly chart again, once the market broke above Thursday's highs, formally that triggered the L.I.V.E rule set, the AA rule set, the aggressive ambush, saying now's the time to focus on the sell side. The market collapsed, broke below Thursday's lows, the AA rule set reversed and said now's the time to focus on buy setups. One had to wait for 1 hour, 2 hours, 2 a.m. my time, for the buy setup to come along on the 60-minute chart, and that was a retest variation as a buy setup. It was also a coil saying look for a bit of expansion of range volatility coming in. The retest variation was saying look at the buy side on the hourly chart. The 30-minute view provided another retest variation buy setup. So we had a retest variation buy in the 60-minute and a retest variation buy in the 30-minute. The 15-minute view, strangely or not, was also a retest variation buy. So we had a confluence of 3 time frames, all providing the same buy signal. The 15-minute bar, the following bar, was an inside bar, so the buy level was not triggered. The following bar did trigger the buy setup on the 15-minute chart. By now the 30-minute chart has finished. We have a higher low on the 15-minute chart, thereby we can raise our initial stop loss to just below the last 15-minute bar's low. Next bar comes along on the 15-minute chart, expanded range to the top side, higher high, higher low, promise of higher highs. We can now raise our stop to the last low, making this better than break-even campaign. Market continues to rally for 1 bar. We go, okay, we can raise our stop up to there, or we can look to the 30-minute to see if we can have a more laid-back approach. And sure enough, The chart just jumped. We're there. You can raise the stop to the 30-minute low, and from there on, trail it up below each bar's low and getting stopped out on the bar highlighted there. The software today seems to be giving me a hard time by jumping and not doing what it's supposed to do, but I guess such is life with computers. So just recapping, the AA aggressive ambush dictated looking for sells when it broke above Thursday's highs. The AA ambush said look for buys when it broke below Thursday's lows, and there was a textbook retest variation on the 60-minute, 30-minute, and 15-minute time frame to take advantage of the buying confluence. Before the figure came out, on the hourly chart, there was a Von Trapp buy, a smaller range confluence signaled by the 30-minute, and a fake out buy on the 15-minute. So what you're beginning to see is that trading really can be very, very boring because we're seeing a lot of repetition of the same setups on different time frames, different markets as well, and they've been around for a long time. As I said, the L.I.V.E ruleset was conceived in the early 1980s, and here we are in the year 2012. Thank you for watching. Catch you next time. Bye for now.